Hello, everyone. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled Introduction to Private Label Investor Residential Mortgage Loan Securitizations. My name is Hawker Goodmanson, and I am a partner in Mayor Brown's Chicago office and a member of the structured finance practice. I concentrate my practice on a range of matters related to residential, commercial, and consumer loans and related assets. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the telephone conference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to gfm@mayorbrown.com, and we will respond promptly. This is the same email address on your invitation email. Joining me today are my colleagues Chris Cully, Tamim Zanelbai, and Jenna Siebold. Chris is a partner in our Washington, D.C. office and a member of our Consumer Financial Services Group. Chris concentrates her practice on federal and state regulatory compliance matters affecting providers of consumer financials, products, and services. Tamim is also a partner in our Chicago office and a member of our structured finance group with a focus on residential mortgage loans and other consumer and commercial assets and other structured finance transactions. Jenna is an associate based in our Chicago office and is also a member of our structured finance practice, focusing on securitizations and other transactions involving mortgage loans and related assets. With those brief introductions, we will now begin today's discussion. Following the FHFA's recent restrictions on GSE investments in loans secured by second homes and investment properties, private label securitizations have become a more attractive option for exit, and we have begun to see a bit of a proliferation of these types of transactions in the market. Our presenters will provide an overview of these securitizations, how they are structured, and highlight some of the issues to keep in mind when considering sponsoring a program. To a large extent, investor loan securitizations are very similar to other residential mortgage loan securitizations, particularly prime jumbo and non-QM securitizations. But there are also differences that we will highlight as we go along. Our goal here is to keep the presentation at a relatively high level because we have many topics to cover. But many of the issues we'll touch upon are both complicated and nuanced. Therefore, we invite you again to reach out to any of the panelists, either through the email address I mentioned earlier or directly if you have any questions or would like to discuss any of these topics in greater detail or any others. First, the investor loans are essentially commercial loans. The regulatory overlay, therefore, to consider is much simpler than that applicable to the securitization of consumer loans. I now turn it over to Chris Cully to summarize the regulatory framework and highlight some of the key regulatory considerations. Chris?
Thanks, Hawker. As Hawker mentioned, I'm Chris Cully. I'm from the D.C. office of Mayor Brown, and I did want to start off with some regulatory compliance issues. And by that I mean compliance with the laws and regulations that relate to the underlying mortgage loans themselves. So we're talking about loans secured by perhaps second homes or by investment properties. As Hawker mentioned, these loans may be attractive for private label securitization due to the caps on Fannie Mae and Freddie Mac purchases. But another reason these loans may be attractive assets is that to a certain extent, the compliance hurdles related to the origination of the loans is significantly reduced. In short, there's a lot less to worry about from a compliance perspective. Generally, of course, residential mortgage loans are a highly regulated product. Federal and state laws and regulations address just about every aspect of the relationship between a mortgage lender and a consumer borrower. There are regulations addressing the origination process itself, disclosure requirements, fee restrictions, restrictions on terms and conditions, and of course, there's a significant emphasis on the servicing of the loans, just stacks and stacks of regulations that are changing all the time. However, most of those requirements apply only in connection with consumer purpose mortgage loans, meaning the borrower is going to use the loan proceeds primarily for non-business purposes, for instance, to finance the home they live in or to get cash out for home improvements, etc. Few of those regulatory requirements apply in connection with loans that are primarily for investment purposes. I did want to highlight, of course, today we are focusing not just on loans that are secured by wholly investment purpose properties, but also on loans secured by second homes. Those loans may be consumer purpose loans, unless the borrower actually intends to rent the home out for most of the time, in which case it's considered an investment property. So in connection with the loans we're discussing today, it's very important to understand the extent to which the loan proceeds are being used by the borrower primarily for investment purposes or instead of for personal purposes. One can't just lump together in one pile all these loans, at least not for compliance considerations. One really needs to consider the extent to which the loan proceeds are used primarily for consumer versus business or investment purposes. And I will note that while business purpose loans are subject to a significantly reduced set of regulations, there still are some regulatory compliance requirements that apply, even in connection with loans secured by investment properties. For instance, fair lending principles under the Equal Credit Opportunity Act continue to apply to business purpose loans as well as to consumer purpose loans. Also, a few states require that the lender and or the purchaser of the loans and or the servicer of the loans must obtain a license. And in a limited number of those states, a failure of the originating lender to be properly licensed can actually impair the validity of the loans themselves or the ability to collect the interest on those loans. So it's important to understand those licensing obligations. In addition, certain states increasingly are determining that the underlying borrowers, even under investment property loans, need some regulatory protection. So some states impose disclosure requirements or prepayment penalty regulations on commercial mortgage loans in a similar way to regulations found in consumer purpose lending. One other way in which regulations that are typically applicable only to consumer purpose mortgage loans are creeping into the investment property loan sphere relates to data collection and reporting. The Dodd-Frank Act actually contains a provision that will require lenders to gather and report information on loan applications by small businesses and by women-owned or minority-owned businesses. The goal of compiling that data is, as you might guess, to detect unlawful discrimination against those business owners. So certain data will have to be collected, maintained, and reported to the CFPB, the Consumer Financial Protection Bureau, including whether the applicant is a woman-owned, minority-owned, or small business. So obviously the CFPB will have to flesh out those definitions. The type of action taken on the application, the size of the business, and the race, sex, and ethnicity of the principal business owners. So those requirements are not effective yet. They'll kick in once the CFPB finalizes rules on the topic. The agency has not started yet. It intends to start that process this fall. So while all of that starts to sound like a lot of regulation, to the extent the loans, these loans that are secured by investment properties, are truly loans that are primarily for investment purposes, the loans do actually escape many fairly onerous federal and state regulatory requirements. Investment purpose loans are not, for example, subject to the CFPB's ability to repay / qualified mortgage rules. They are not subject to restrictions on loan officer compensation. They are not generally subject to federal and state restrictions for high-cost loans, these so-called anti-predatory lending restrictions or subprime home loan restrictions. So these exclusions are really important because otherwise a failure of the originating lender to comply with those requirements could lead to assignee liability or to a defense that the borrower can assert in a foreclosure action down the road without regard to otherwise applicable statutes of limitation. So the fairly good news from a regulatory perspective is that these loans secured by investment properties are free from a lot of the regulatory compliance headaches of consumer purpose residential mortgage loans. So with that, I'll turn it over to my finance colleagues, Tamim and Jenna, to discuss how these deals can work. Tamim?
Thanks, Chris. As Hawker mentioned, my name is Tamim Zenelbai, and I'm a partner out of the Chicago office in the Finance and Securitization Group. I'm going to talk about some of the features of securitizations of these types of investor loans. So the securitizations are typically structured to be bankruptcy remote. In other words, if the seller of the loans into the securitization vehicle goes bankrupt, the assets and liabilities of the securitization issuer will not get consolidated into the seller's bankruptcy estate. To accomplish this, we create a special purpose depositor entity, and the seller sells the loans into this depositor, and then the depositor deposits the loans into a New York common law trust, that is the securitization issuer. The sale from the seller to the depositor and from the depositor to the issuer is considered a true sale for legal purposes. I should also note that the issuer is not required to be a New York common law trust. It can also be a Delaware statutory trust or other type of special purpose entity. Each of the depositor and issuer are special purpose entities that do nothing else other than their role in the securitization. And rating agencies also typically require opinion coverage on this structure and its bankruptcy remote features. The bond structure for these securitizations is also fairly standardized. So typically there's an A1, A2, and A3 senior classes that are offered and are investment grade. There's a mezzanine class called the M1, which is also investment grade and an offered class. And there are the B1, B2s, and B3s, which are all offered but not investment grade. Then there can also be a class XS, which is entitled to excess interest, which I will describe later, as well as a class R residual certificate. So these bonds are typically fixed rate and pay what they call modified sequential. So if we look at the waterfall, that means that payments are split between interest waterfall and principal waterfall. So for interest, each class is paid sequentially, the amount of interest due for that period plus any unpaid interest that was due but unpaid from any prior period. For principal, there is a pre-trigger waterfall and a post-trigger waterfall. So prior to any trigger, the senior classes, the A1s, A2s, and A3s, are paid unpaid interest to the extent they didn't get it in the interest waterfall, and then are paid principal pro rata. So what this means is that if the deal is performing, then the senior classes, the A1s, 2s, and 3s, get paid principal on a pro rata basis, which is the modified part of the modified sequential structure. All non-senior classes get paid sequentially. So in other words, principal distributions that hit the M1 class go first to pay accrued and unpaid interest due to the M1, and then to pay down the M1 until its balance is zero, and then so on and so forth to the B1, B2, B3, etc. The trigger concept is an event that occurs when a certain percentage of the pool is more than 60 days delinquent, so that's the delinquency trigger, or a certain percentage of the pool has incurred realized losses, and that's called the cumulative loss trigger. If there's a trigger event, the bonds pay principal on a purely sequential basis. So the A1s get all principal distributions until the balance of the A1 is zero, and then you go to pay the A2s, then the A3s, and et cetera, et cetera. If there's any cash left over at the end of these interest and principal waterfalls, that excess cash goes into what's called the monthly excess cash flow waterfall. And any cash going into this waterfall first goes to reimburse any classes that have experienced realized losses, and then to reimburse any class for something called cap carryover amounts. And those are if the weighted average mortgage rates of the underlying mortgage loans was ever below whatever the fixed interest rate is for any of those classes, then you get paid that lower number. And this prong of the waterfall allows you to get reimbursed to the extent that happened. Then the next prong of this excess cash flow waterfall is all excess cash goes to the excess holder. The class XS is typically held by a sponsor or an affiliate of the sponsor of the deal. And then there's also sometimes a class called the AIOS bond, which represents the right to get an excess servicing strip, and also cash flow that would otherwise go to that bond goes to pay any compensating interest payments. Generally speaking, these securitizations can be outstanding until the last payment of the last surviving loan, and for these loans that could be as long as 30 years out from the closing date. However, the depositor and servicer typically have the ability to redeem the bond a little bit earlier. Typically, the earliest a redemption can be done is the later of 3 years after the closing date and the date that only 30% of the pool is left outstanding as compared to the size of the pool on the closing date. Upon a redemption, the servicer or the depositor would pay the stated principal balance for all outstanding mortgage loans or the fair market value of such loans, whichever is higher, and all outstanding accrued and unpaid interest, fees, expenses, and indemnities. As you would expect, these deals are typically redeemed prior to their final stated maturity date, which is the last payment of the last surviving loan. Finally, there is a lot of tax structuring that happens with these transactions, and typically these investor loan securitizations are structured as a REMIC, which is a tax construct that imposes certain limitations on the transaction, including on the bond structure, but has the benefit of preventing the securitization to pay any income taxes on the transaction. However, REMICs are very complicated and can easily be its own discussion, so I'll leave that further discussion on REMICs for our tax experts. Next, I turn to Hawker to talk about risk retention. Hawker?
Yeah, thank you, Tamim. As Tamim alluded to, one of the key differences compared to a typical prime jumbo RMBS securitization is that investor loan securitizations are generally not exempt from the U.S. credit risk retention rules because the loans are generally not qualifying residential mortgages as defined under the rules, which for now at least is the same definition as qualified mortgages definition under TILA. As a result, the sponsor of the securitization, either on its own or through a majority-owned affiliate, is required to retain at least 5% of the credit risk of the securitized assets for the prescribed retention period, which effectively requires the sponsor to retain skin in the game, if you will, for that period of at least 5%. I note here also that even though most deals try to comply with U.S. risk retention rules as well as the EU risk retention rules to broaden the potential pool of investors to include EU institutional investors, the EU rules are different, although the end result of complying with both is often very similar or identical. However, in this context, the EU rules generally only apply if we're marketing to EU investors, and today we'll focus on the U.S. rules. The U.S. rules provide several methods for holding the required retained risk, but the most common for RMBS securitizations are eligible horizontal interest, eligible vertical interest, or L-shaped interest. The eligible horizontal interest basically consists of the most subordinate interests in the securitization, excluding the non-economic REMIC residual, which Tamim referred to as the Class R earlier, and can consist of a single tranche or multiple subordinated tranches. If the sponsor is only retaining the eligible subordinated interest in the securitization, that interest must equal at least 5% of the fair value of all the interest issued by the securitization entity, and requires the determination of that value and the disclosure of the methodology used all to be performed in accordance with GAAP. As a general matter, the holder of an eligible horizontal interest bears the risk of first loss occurring in the pool to the extent of that horizontal interest. The second common option is retaining an eligible vertical interest, which requires that the sponsor retain at least 5% of all of the interest issued in the securitization, or in other words, at least 5% of each of the tranches that are issued. The eligible vertical interest can also consist of a single vertical security that's created for purposes of risk retention that constitutes that same proportion of each of the tranches. The third option, or third common option, I guess I should say, is a combination of the first two. That is, the sponsor can retain the so-called L-shaped interest, which is a combination of a horizontal and vertical interests described that I just mentioned. And together, those interests have to constitute at least 5% of the credit risk. Generally, the sponsor must retain the risk until the later of 5 years after closing and the date on which the unpaid principal balance of the securitized loans has been reduced to 25% of the unpaid principal balance at closing. And during that time, hedging of the credit risk is generally prohibited, although interest rate hedging is permitted with some exceptions. However, the rules do permit the financing of the retained risk so long as the financing is full recourse, whether it's through a repo facility or a secured loan or otherwise. But one of the reasons to select the vertical interest retention over the horizontal is that it may be generally easier to finance the higher rated tranches in the transaction compared to the most subordinate tranche. Another consideration that I'll mention here when designing a securitization program is how do we identify the sponsor, that is, the person that is required to retain the risk. The U.S. rules define the sponsor as a person who organizes and initiates a securitization transaction by selling or transferring assets, either directly or indirectly, to the issuing entity. And in many instances, and maybe most instances for these types of transactions, the identity of the sponsor is relatively clear. For instance, in a single seller securitization sponsored by the originator of the loan, it's fairly easy to point to the sponsor. In other contexts, for example, fund-sponsored or joint ventures or similar arrangement, it can be less clear at the outset which entity is the appropriate sponsor. So that's something that one should focus on the early stages of designing the program. But that's it for the U.S. risk retention rules, and I now turn it over to Jenna Siebold to talk about the typical disclosure documentations that we see in these transactions, as well as the all-important reps and warranties and the related resolution process. Jenna?
Thanks, Hawker. As Hawker mentioned, I'm going to speak briefly now about the disclosure document as well as the representations and warranties and the remedies for breaches of such representations and warranties. Under federal securities law, an issuer may not offer or sell securities unless the offering has been registered with the SEC or is exempt from registration. Regulation AB contains a regulatory framework for registering offerings of asset-backed securities. Securitizations of these investor purpose loans, however, are typically not offered under Regulation AB, but rather are privately placed in reliance on Rule 144A. Nevertheless, as private placements are not subject to a particular disclosure regime, most issuers look to Regulation AB for non-binding guidance as to which information should be included in the offering materials. They look to Regulation AB for guidance in part due to issuers being subject to strict liability under Rule 10b-5 of the Exchange Act, which makes it unlawful for any person, directly or indirectly, by use of any means of interstate commerce or any national securities exchange, to make any untrue statement of a material fact or to omit to state a material fact necessary in order to make the statements made, in light of the circumstances under which they were made, not misleading. Regulation AB provides guidance on disclosure to investors and contains specific requirements regarding the method, timing, and content of information that needs to be disclosed to investors. Now I'm going to touch on some of the items that are typically included in the offering memorandums, some of which my colleagues have already discussed. The disclosure document will always contain a description of the bond structure, as well as any credit enhancement features. These credit enhancement features include, for example, subordination of lower classes of notes to more senior classes, over-collateralization of notes, and possibly a reserve account with a minimum balance requirement. There will also be a description of the transaction parties and the transaction documents that will be executed at closing. Each disclosure document will contain fairly extensive risk factors that cover both general market risks, including risks due to the current economic conditions, regulatory regimes, and any substantial market events, such as most recently COVID-19, as well as deal-specific risks, including risks that arise based on specific pools of loans, the transaction parties involved in the deal, and any other deal-specific features that might be of a concern to investors or that could affect investor returns. Other items that are typically included in the offering memorandum include the tax characteristics of the deal, collateral characteristics and the historical performance, underwriting or acquisition guidelines, the projected performance of the bonds, third-party diligence results, risk retention, and disclosures made by third parties, such as, for example, servicers, trustees, paying agents, custodians, and possibly originators. With the strict liability standard dictated by 10b-5, it is important that the disclosure is correct and every section should be carefully reviewed. The offering memorandum will also contain a fairly robust disclosure of the representations and warranties being provided, the party providing them, and the remedies if a representation or warranty is breached. Many factors go into the decision on which reps and warranties to include, but the collateral type will be crucial, as well as any rating agency criteria if the deal is rated. With respect to investor purpose loans, the rep packages are typically similar to those you would find in a non-QM securitization, and they include, among others, reps related to the ownership of the loans and the loans being free of any senior liens, making sure the information being provided with respect to the loans is true and correct in all material respects, the losses that may be suffered with respect to the properties underlying the mortgage loans being covered by appropriate insurance, policies and underlying properties are not damaged or have any environmental concerns. Investors will want to know that the mortgage and related documents comply with all applicable laws, are valid and enforceable, represent a legal and binding obligation of the mortgagor, and haven't been modified in any way unless disclosed to investors. Often there will be a requirement that the mortgage loan be covered by title insurance and that the mortgage file includes some sort of evaluation or appraisal with respect to the underlying mortgage property. To the extent the sponsor of the deal is the buyer or aggregator rather than the originator of the loans, they will often try to conform the reps in the securitization to those given in the underlying purchase agreement. If any of the representations and warranties are breached, and if such breach is a material breach, then an obligation will arise to cure the related breach or repurchase the affected mortgage loan. Sometimes, rather than curing or repurchasing a loan, an indemnification payment is made to cover the costs or the affected mortgage loan can be substituted for another unaffected loan. With respect to this asset class, repurchase is almost always the remedy or substitution. The party determining if there has been a material breach varies from deal to deal. It is often the servicer or the seller, but it could be the issuer, the indenture trustee, or another party who is given the responsibility for making such a determination. Sometimes a certain threshold of note holders can also trigger a review. If note holders can trigger a review, the documents will contain mechanisms for resolving disputes between the note holders and the deal parties, which often includes arbitration. The documents will be specific on how long the seller has to cure a breach and the price that would need to be paid to repurchase the loans or make an indemnification payment. Often the party that sells the loans into the deal will be the party making these representations and will have the obligation to cure or repurchase the loan if a material breach of the reps has occurred. However, if the seller is an SPV or for any other reason is unable to make the reps or satisfy the repurchase obligations, a parent or other entity will step into this role. Investors will want assurances that the entity with the repurchase obligations is sufficiently capitalized in order to meet their obligations. Thank you. I'm now going to turn it back to Hawker for closing remarks.
Thanks, Jenna, and thanks to our audience for tuning in. A few brief reminders to close us out. You will receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Lastly, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation. You may all now disconnect.